I want you to imagine that you just set your order and market activated your order. How you will going to feel, be like, you are not sure what you are doing. Once price start to go to your stop level, you're about to close the position. And having this idea that price can hit your TP, it's going to be impossible for you. Then you realize you was on wrong side of the market and there is no way back. That's because you don't have a clear understanding about liquidity and a mechanical strategy to place it in the market. Due to the studies, one of the important reasons that 90% of the traders fail is not because of the poor money management and lack of discipline or even a loosey trading method. The biggest reason people fail at trading is because they don't have a clear understanding about how liquidity works. Let me introduce myself. My name is Ebol, I'm 19 years old, 6-figure investor, capital and day trader. It's better to just introduce myself like this. It's better now. Recently, I just run my own hedge fund at 19 years old. I share my trade to my teammates every day and I use liquidity strategy and at least it's worked for me and for my students and my teammates. In this video, I will going to teach you all things that you need to learn about liquidity and teach you a mechanical strategy that you can apply it right after this video. At the end of the video, I will going to teach you how you can download the ebook that I designed just for you with 100 of example for free. Before we start, put a like button and subscribe and grab your coffee and note because this video is going to be life changer. Let's dive in. Okay, so let's start. Now we're going to talk about what market makers doesn't want you to know about the liquidity. So first of all, we should understand what is the liquidity in Forex market. The Forex market is like a vast ocean with the liquidity being the water that allows traders, that we're talking about the boats here, okay, to move smoothly. So if I want to give you a clear understanding about what is liquidity and pretty much what we are and what is the liquidity and what the Forex market, it's going to be the Forex market like an ocean, okay, and pretty much these water here is going to be the liquidity that help traders to pretty much start to move smoothly. So these boats are traders. It doesn't matter the big players or the small player or pretty much retail traders. Okay, so I'm just gonna move my webcam here. When liquidity is high, like during the overlap of the major trading session, the water is calm and trading is easy. Okay, so once we have a bunch of water, let's say like a special session like NY, we know, for example, in the Euro USD or JBP USD, we have some special times that we're going to see a bunch of liquidity on the market. So if we want to, again, give them example, it's going to be at that situation, once we have a bunch of liquidity, the water is calm and trading is easy. But when liquidity is slow, such as during the off-hour or low interest events, the water became choppy and harder to navigate. Okay, so that reason, let's say you are captain of the boat, try to start to, for example, move or start to pretty much set your navigator or start to, for example, travel. And that time, which that is going to, you're going to see good water, right? There is no choppy water, there is no waves over there. So it's going to be the special time on the market. So these are so important. Knowing when the water are smooth or rough help trader make better decision and avoid unnecessary risk. This is so important. And if I also want to give you another example from the who are the market makers and the big players, you see these cargo boats. Once they move, pretty much it's going to be it's going to be at least, let's say, creating some waves, small waves in the market, in the water, right? So these are, we can say these are big players, and the small boats, the small fishing boats, it's you. Just remember this example, because with this example, I'll be going to show you a lot of liquidity logic, which is going to be make sense for you. So these cargo boats, it's going to be the market makers. So the fishing boat cannot move, let's say, side to side of the, let's say, the big players or the cargo boats, right? Because the cargo boats, the wave that they're going to create is too high, and what's going to be happen, the fishing boat is going to be fall down. So let's go to the first type of the liquidity that we're going to learn. It's going to be the buy side and the sell side liquidity. So we're going to start from a buy side liquidity. First, what is the buy side liquidity? Above every swing high that has not yet been broken, there will be buy side liquidity resting above in the from of a buy stop. So above every swing high or three candle confirmation. If you don't know what is three candle confirmation, just let me just give you a quick understanding about it. Just take a look. 1, 2, 3. We have a three candle here, right? The second candle have the longer high, and same thing for the swing low. So the swing high and swing low for us is a three candle confirmation. We are not talking about pretty much this highs, or this highs here. We're just talking about the three candle confirmation. So above every swing high, which has not yet been broken, there will be a buy stop order. Okay, there will be a buy stop order, or pretty much, yeah, we can say the buy stop order. So just take a look to here. So this is a swing high that price didn't broken it yet. So trader will place these buy stops above swing highs in the hope that once price breaks above it, will go higher and higher and higher. Okay, so the retail trader are gonna set their buy stop and above every unbroken swing high, and what they believe is to price break this and start to go up, and they're gonna set the stop loss here. I hope you can see my stop loss here, and this is going to be their entry, right? But the important thing is, now pay attention here. This was the buy stop order that trader set, the retail trader set, and this was their stop loss here. Price broke this swing high and reversed. So the thing is, the market makers, these cargo boats, let's say, they know the fishing trade, let's say the small boats or fishing boats, it's going to be the move here. So what they're gonna do, they're gonna give them a little bit wave, okay, that they are like it, but what they're gonna do, they're gonna start pretty much, we can say, start to grab all of the, let's say, we can say the movement that they had, right? So what they're gonna do is they're gonna activate the retail traders order, then they're gonna start to reverse. So if you think about, okay, why price just give them a little bit profit? Because price, there is two options here. If you see in the retail traders area that price just give them a little bit profit, okay, or start to at least move a little bit, that's mean price just making more liquidity at these areas, because you don't know, there is a bunch of retail traders scalper that they are going to enter at these areas, especially these areas. So this is going to be just building more liquidity for them. Now if you take a look here, what will usually end up happening is the market will reverse after triggering those buy stop, leaving those traders stuck in drawdown or hit a stop loss. Okay, so we understand above every buy stop and a sell stop, it's for now buy stop, it's pretty much retail traders order. So what market gonna do, let's say above every unbroken buy stop and sell stop. So what market gonna do, market gonna activate them and start gonna reverse, gonna activate their liquidity, activate their order, they're gonna start to reverse. Now let's dive into the next example, which that we're going to talk about the sell side. It's same like a buy side, okay? So below every swing low that has not yet been broken, there will be sell side liquidity resting below in, okay, from the sell stop order. So again, the trader will place these sell stop below swing low in the hope that one price break the low, it will go lower and lower. But so we understand, again, same thing at the sell side. We have below, let's say, every unbroken swing low, we have sell stop order, okay? So the retail trader are going to set their sell stop here. Sometimes they think they are so smart, they're going to set it here, okay? And a stop loss here. So what are price going to do? Going to act. They believe pretty much they hope that price gonna break this and start to come down. But what price gonna do? Give them a little bit of profit and start to reverse. Guys, you don't know, there is millions of retail traders that trade like this. So don't think, these are just a concept. These are not concept. These are real. There is a million traders that trade like this. Okay, if you just start a little bit research in the retail trader are there, you're gonna see this. So now let's dive into the next one. the sell side liquidity. So what we're going to see here, the lead trader price broke this swing low and start to reverse. Okay, I'm going to move my webcam here. And what we can see, price activate them, give them a little profit and start to reverse. Just take a look how price took the liquidity here. What will usually ends up happening in the market will reverse after triggering those sell stop, leaving those traders stuck and draw down on his stop loss. When price does this, we call it stop hunt. So once price take out the buy stop and a sell stop order and start to reverse, okay, let's say just swap the sell side or the buy side liquidity, we call this a stop hunt. Make sure, just remember this, okay? We're gonna dive into with this stop hunt a lot. So this is going to be the stop hunt. Now, let's take a look to some examples here. Okay, I'm gonna go like this. So this is the full chart example. So you can see there's green is buy side and these are the red one is the sell side. So what we can see that above every three candle unbroken swing high, it's a liquidity. Just take a look. Price break this, give them a little bit of profit, start to reverse. Same thing here. Just take a look to the sell side. Price break this, activate the orders, just give the little bit profit here, right? And start to reverse. Same thing here. Break this, give the profit, start to reverse and take their stop loss. Break this and give them a little bit of profit, start to reverse. You can see bunch of these examples in the chart. Now, I want you pause the video right now and just take a look to these risk examples and repeat this for yourself, like how I did. Price took the sell stop, okay, and just activate them, give them a little bit of profit, and start to reverse. I know you understand the concept, but repetition is so important. That reason I want you, even if you know, even if you are the best trader in the world, if you really want to learn, please just stop the video right now and just repeat this for yourself. So, thank for the practice. Now let's continue. So now you understand the buy side and the sell side liquidity. We're going to dive into the more liquidity type. So this third, let's say, type of the liquidity that we're going to talk about is going to be the equal high. So equal high are points on a price chart where the market has consistently reached the same high level multiple times. So let's say we had a high here, okay, the price didn't take this high, and in the next mitigation, price create an equal line, okay, algorithm, let's say, with the previous high, okay. So the traders view these areas as a sign, as a, let's say, resistance. Okay. However, it's important to note that often the market does the opposite, leading to potential price reversal. Additionally, traders may attempt to sell at these levels, believing there is very much represent a strong resistance. So now, once you see this, if you are, let's say, after this video, once you see these type of the repetition, and let's say these, let's say equal highs or equal lows, what are you gonna think? Is going to say this is a liquidity, but how retail trader gonna think? They're gonna say, okay, price is a respecting from a resistant area, which they gonna let's say mark the resistant area as a line, because they believe the price gonna play in this line and they're gonna respect. So this is going to be the resistant area, and what they gonna believe. Most of them, I can say 19% of them believe, not 90% of them believe what price gonna do in the next mitigation. Price is still going to be respect this resistance, but we know this is a liquidity. Even if price want to respect in the other mitigation, which that is going to be the, let's say, another type of liquidity that I'm going to talk about. This, it's going to be again a liquidity at the end of that. Now, so what we can see, they think price gonna tap to here and give us the reaction again. So they put their sell limits here, okay, and the stop loss above this. Now, what they don't know is what price gonna do. Price gonna take, let's say, activate their order and take the liquidity. When the price eventually breaks through, it triggers stop losses from these sales order, creating an influx of liquidity in that area. Okay, when price does this, we call it stop hunt. Remember, once price took the liquidity, we call that let's say stop hunt. It doesn't matter, the buy side, sell side, equal high or even equal low, it doesn't matter. Even once your stop loss hit, we can say you just get a stop hunt, right? So that reason, just remember this is stop hunt is so important. So a stop hunt in simple language, once markets strip the liquidity, we can call it the stop hunt. So again, just remember this diagram here. This is the market makers, this cargo boat, and this is the fishing boat. This is you, or this is a retail trader. Okay, they think they're here is a good area for move, but the cargo boat's gonna create this wave, so they're gonna go under the water, right? So let's dive into the next point of the liquidity, equal low. Again, it's the same as equal high. So how this is going to be work is going to be equal lows or points on a price chart where the market has consistently reached the same low level multiple times. Okay, we can say, when I say multiple times, that's mean minimum 2. Okay, you can't say without the second one, you can't say price just, is creating an equal high or equal low. No, minimum 2. You should have minimum 2 respect or mitigation to call this equal low. So traders, let me just move this a little bit higher. Traders view these areas as a sign of support. However, it's important to note that often the market does the opposite, leading to potential price reversal. So it's the same thing. Additionally, traders may tap to buy at these levels, believing these represent as a strong support. So it's the same thing as an equal low. So what traders going to believe? They're going to say, okay, these are an equal mitigation. So they believe this line is work as a support. And what they're going to believe, they were waiting to price tap to here and give us this move to the upside. Okay, this is the hope that they have. But so what they're going to do, they're going to set their order here, the buy limit and the stop loss here. Guys, there is a million and millions of the traders that trade like this. Okay, so don't think because you know this, everyone gonna know that. No, there is a bunch of traders, they don't know what is the equal high and equal low, so they point of view is completely different. So, and what's gonna be happen is when the price eventually break through it, trigger stop losses, and what's gonna be happen? So price gonna activate their order. Sometimes you're gonna see price give a little bit of reaction, okay, to you're gonna see prices tap to this buy limit, give us the little bit of reaction to top side. The reason of this reaction just to price and invite the low time frame scalpers for re-entry here, and they're gonna take the orders like this. Okay, so again, don't forget this diagram is so important. Okay, now let's dive into the different with the valid equal highs and valid equal highs or lows. So first we have a clean equal high or low. Next we have what called the relative equal high. So this is a clean equal high, which the line is pretty much it's equal. It's not like this or it's not like this. The price gonna respect in the same level of the price, or a little bit of, let's say, downside from the second point in the equal high, or a little bit up from the second point in the equal low. So we call this a clean equal high or equal low, so which did is valid, is going to be valid. The next one we call this relative equal highs or low, and then lastly we have the invalid equal low. So what is relative equal high and equal low? It's pretty much in the equal high, the first mitigation, it's higher than the second mitigation, which this is valid, so it's gonna create your line like this. Okay, but remember, if your line's like this is not an equal high, guys. This is not an equal high. Okay, just a little bit realistic. This is not an equal high. And in the equal low, the first mitigation should be lower than the second mitigation to make the line like this. Okay, I'm sorry, this should be mitigation. Okay, so that reason this is still a valid equal high, so we call this relative equal high or equal low. But in the third type, if the first mitigation in the equal high it's lower than the second mitigation in the equal high, this is not a equal high. This is the stop hunt. This is not an equal high. This is a stop hunt. See, just buy sell liquidity take up here. Same thing. If in the equal low, if the first mitigation is higher than the, let's say the second mitigation is lower than the first mitigation, this is not equal high. This is a stop hunt, okay? And you can't say this is equal high. Don't mark the equal high like this. No. Pay attention. So I hope you can understand it. The reason being is price made a stop hunt. So in some situation, we will not expect the market to trade above or below them, as I told you. So let's dive into some examples. Let me just see. There we go. This is a full chart example, okay? So I'm going to explain some of them, and I want you to, again, just pause the video and pay attention to this. So first, let's start with this. So what we can see, this is the equal low. So the retail trader think, okay, this is going to be, let's say, the support area for them, this line, because the first one mitigate, the second one mitigate, and these are respecting, and these are equal low. These are relative equal low. The first mitigation is lower than second mitigation in equal low. So this is going to be bunch of liquidity here. So the retail traders looking for sell at these areas, and they're a lot of them putting their stop loss below this area, or a bunch of them putting their stop loss at these areas. But it doesn't matter for market makers. They're gonna take the all. So what you're gonna see, the market maker take them. So this was their entry point, okay? And this was their retail trader stop area. Most of them they put the stop loss here. Most of them put their stop loss here. We don't know, but the market take them down. Now let's take a look at this. Let's take a look to this. So what we can see, it's a trick in the confirmation. It's a swing high. It's a swing high. There's equal high mitigation should be swing high. Pay attention. And we can see pretty much the first mitigation, the second mitigation, this making a support area, right? So what we can see here, it's the retail trader is going to think, okay, they're going to put their entry here again, okay? They're going to put their entry at these areas. And they're going to put the stop loss here. So they're going to see the good support area. But what's going to be happen, you can see, even if price give their mitigation here, okay, this is not a valid one because, I mean, this is just creating bunch of liquidity in low time frames. And as you can see, and price swoop them all, okay? So you should understand this. Now I want you to just pause the video and just mark this, just have a training like for these type of the liquidities here. Okay, I hope you have that practice, and I hope you understand the equal high and equal low. Now we're going to dive into next type of the liquidity. That's going to be the trend line liquidity, okay? So the trend line liquidity, the next form of liquidity we will going through is the trend line liquidity. This is a very obvious form of liquidity build-up for us, okay? It's so obvious and it's so easy to understand the trend line. And trend line is one of the best and one of the favorite liquidity that I have, liquidity type that I have. So how the trend line gonna be work? It's very known from a huge percentage of traders to try to trade a trend line bonus and the trend line breaks and resist. So how it's going to be work? It's exactly like a equal high and equal low logic, but there is most of the traders believe the trend line actually going to be respect, because the reason most of the traders, the retail traders, they believe the trend line going to be walk because of the market maker movements, the market maker trick, I call it, that big boat, that cargo boat trick. What they're going to do, they're going to create more than let's say multiple reaction on these trend lines to make retail trader believe this is the only and best. This is the only and the best resistance that they can have. So they're going to convince them to the buy. Okay. So what's going to be booked? So here we have an equal high, right? So the retail traders, they're going to try their chance. They're going to buy and they're going to say, wow, respect. Here we go. So, and some of them believe because of this break of market structure, they are in great support. Okay. And they're going to try their chance again and they're going to see respect. Again, they have a, let's say, reaction. They are in profit. They are happy, right? The market maker is still going to give them a reaction again. They are super happy. And they want to buy here again. They call out their friends. They're going to say, let's buy here. They're going to post it on the social media. They're going to do everything to convince every followers or everyone to start to buy here. And this is one of the important trick that market makers use to just believe you that liquidity is still playing good, but you should be understand this is a trick. Don't fall for that trick. If this is a liquidity in your trading plan, just stick to on it. So, and what you're gonna see, we're gonna dive into these trick more. I'm gonna teach you one of the important trick that we call it inducement. So you're gonna understand it. So the retail trader is gonna set the buy limit here, stop loss here. So they are super happy they had previous positions. Maybe they missed that position, who knows? But they are super happy. And what's gonna be happen? I think I forget to create that slide, but I'm gonna add it. No worries. So what's gonna be happen? Price gonna take them. Let me see. Do I create that slide here? I think there is a little bit. Okay, yeah, maybe I forget. But what's gonna be happen? It's going to be a price gonna take them all this liquidity. I'm gonna show you one example after. Let me just find one example and just show it to you guys. Okay, I hope you can see this here. So I was just to just show you a quick example from this. So let's say this is just a trend line liquidity here. Okay, so they're gonna see in the second reaction, oh, the price just respected. In the third, in the fourth, they're gonna start to buy, and they're gonna see this huge reaction. So they're gonna convince in the next, this area is the best support that they have. So they're gonna buy here, and they're gonna put the stop loss here. And what you're gonna see, price gonna take this liquidity. Okay, even if you take a look, this is the trend line here. So they're gonna buy, they're gonna sell. I'm sorry, they're gonna sell here. Once they see reaction, they still want to sell. See, even in the next reaction, price give it a little bit of liquidity, and see how price took all of the liquidity with one candle in the news. So I hope you understand it. So now let's dive into the next. I hope you understand the trend line liquidity, and yeah. So let's dive into the next type of the liquidity that we have, Asia session liquidity, which one of the important liquidity type that we have. Above the Asia high and below the Asia low, wrist is a lot of liquidity. Since the Asia is generally it's a consolidation period more in the non-Asia pairs, there are traders who will attempt to buy once price break out above the Asia high, and traders who will attempt to sell once price break out below the Asia low. Once again, in the form of the buy side and sell side. So the Asia liquidity is like buy side and sell side that I teach you. Let me just move this here. Okay. But there is a bunch of traders that they are going to believe, they believe, let's say, once in a pair, the Asia session finish, if the market start to first break the Asia high, the market gonna be bullish. So they're gonna put their buy stop here. They're waiting for the market. Just once the market break the Asia high, they can catch that bullish market structure, and the opposite. So they believe once the market first take up the Asia low, the market gonna be bearish, and they're gonna put their stop loss between these areas. So this is going to be the buy stop and a sell stop order. But what gonna be happen here, as you can see, for example, at this area, first what price did, price just took the first Asia high, so price start to go up, give them a little bit of profit, they are happy. Okay, then price gonna hit their stop loss. So the logic behind these movements, market makers is in the drawdown here, to be honest, because market makers spending a bunch of money, bunch of value, and bunch of capital to make these moves. Okay, for sure, some of the market makers so smart, they gonna build up the, let's say, some basic elements on the market to also retail traders start to buy, so they can just add a little bit value, let's say a millions volume inside those retail traders value, to make a little bit fake movement. Then they're gonna start to sell, or they're gonna start a reversal movement. So the logic is this, to be honest. Then as you can see, this huge candle, they're gonna start to sell. That's it. They just build this fake movement with the help of the, let's say, the retail traders. Then they're gonna start to create the major candle here. So here the trader was in the profit, that was happy, but their stop loss hit, right? So also once we go down here, you can see again price tap to the, let's say, active the sell stop order of the a retail trader, they are think they're gonna be bearish, and what are you gonna see? Price. So just take a look to these candles. These type of the candles is a little bit unnormal. These are unnormal. Just take a look at these candles. It's for sure it's a manipulation. These type of the candle we call it manipulation. And what does manipulation mean? That's mean once market makers come to play. Once the order of the market makers come to play. So this exacts the manipulation, right? So what we can see, they just start to sell, high volume sell, right? This is not for a retail trader's order or value. These are just for market makers. Pay attention. They just put millions, billions to sell at this area to just create this movement. So the retail trader order gonna be activated. Now guess what? They're gonna start to reverse it, and they're gonna be in profit, and retail trader gonna start to be in loss. They are so smart. They are so genius, and they are so smart. And all thing they do just play with your psychology. To be honest, all thing they do just play with your psychology, with the retail trader psychology, to once they lost, to make them lost again, to put the maximum value on the market so they can use it and make money with that. So pretty much one of the goal of the market maker have, it's not make money because they have a bunch of money, but yeah, the private hedge funds, the goal of the private hedge funds to make money. So they are not so strong as exactly like in market makers. The market makers, their important goal is economy. Let's say every different countries have their own market makers, so they want to play with the price, play with the pair. So in the war times, let's say, if you remember in the war between the R and U, so I'm not gonna call the country because R and U, I think back 2 years ago, the gold had one of the worst. Also, no, yeah, and back into the, let's say, the virus that we had, okay, the quarantine time. So once the first Russia come to play and I say I'm gonna try the, let's say, the thing, and I'm not gonna say it because of the word in the YouTube. And in the gold, we had a beautiful bearish and dump movement. So the reason was that was a fake news that market makers made to increase the price. No, just change the price, the volume to low, to use it in their own way. So they can buy anything for themselves, or they can use it for their economy. So one of the important goal of the market maker is just to play with the economy. Right now I'm just recording this. We have a little bit, the gold is just breaking out again, right? So these are the gold beside the market makers. So this is just my personal opinion. So let's dive into what now. So now we learn all thing about the liquidity, right? You just learned important part of the liquidity. Now I'm gonna teach you trading range, which that is going to be how you're gonna catch the position, where you're gonna catch the position. One of the important thing gonna completely open your eyes. So just stay tuned. What is a trading range? A trading range is a concept we use to understand where we currently are in the market and how we probably view the market structure. We view market structure in ranges, and you will see at the end of this lesson or video just how clear market structure became for you. Okay, there are a phenomenon that consistently repeats, which we call the trading range cycle. This is one of the important thing about the liquidity that give us an edge. If we understand where we are in the cycle, we can approach the market with a high level of accuracy and understanding of the direction bias. This is how important. Understanding the trading range is a key. So I'm going to teach you how you can understand the trading edge, how you can put the concept in the trading edge, how you can have the open point of view on the trading edge about the liquidity, and you can buy and sell in the trading range. The trading range consists of the multiple different pieces that we will eventually be blended all together, create it. So we are going to break it down into what I call the core elements of trading range. So let's start with the core elements of trading range. So the core elements of the trading range, it's bullish QM and the bearish QM. So now the first core elements of the trading range are the bullish or bearish QM. The QM are what frame the trading range and is how we confirm when a range is formed. They are very easy to understand since there are only two things that need to be happen and identify them. So bullish QM and bearish QM, it's one of the main elements for identify the range. So we call this bullish QM. How the bullish QM going to be formed? We need to see a stop hunt. Do you remember this liquidity stop that I told you? It's a stop hunt to the downside and a break of market structure to the upside. So what do we want to see in the bullish QM? It's a stop hunt to the downside. Okay, let's say this is swing low. It's stop hunt to the downside and a break of market structure to the upside, like this. See, stop hunt happen and break of market structure happen, or you can take this break of market structure. It's the same thing, to be honest. Don't start to dive into the details. It's the same thing, to be honest. You can take these, but it's better to take these, to be honest, because this high formed this low. Okay, it's gonna make your pretty much it's gonna make that break of market structure more valid, because now you have two minor break of market structure, but it's the same thing. To identify the bearish QM, we need to see a stop hunt to the upside. Okay, it's a reverse. It's a stop hunt to the upside and break of market structure to downside. So what we can see is stop hunt to the upside and break of market structure to downside. So this is going to be the bearish QM. So this is going to be the bearish QM. This is going to be the bullish QM. Now, what is the strong high and a weak low? At the beginning of now we're going to talk about, we have two types of the range. We have bullish range, we have bearish range. Okay, in the bullish range, the main position that we're going to look for is going to be buy. And in the bearish range, the main position that we're going to look for is going to be for sell. Okay, at the beginning of the bearish trading range, okay, so if you don't know how the bearish trading range looks like, it looks like this, right? Now we're going to dive in. It's better to understand the concept and elements. We are going to see a strong high, otherwise known as a bearish QM. So in the bearish trading range, the first thing that you're going to look for is going to be the strong high. Just take a look. What was the strong high? Strong high is a bearish QM, or known as a bearish QM. What was the bearish QM? Stop hunt to the upside and a break of market structure to the downside. So take a look. Stop hunt and a break of market structure to downside. So a strong high form. That's it. How easy that you're going to understand this? It's like this. That's it. Okay. Then, at the end of the bearish trading range, we are going to see a weak low, otherwise known as a bearish QM or swing low. So, for the weak low, you can look for the QM, the bullish QM, okay? Stop hunt to the downside, break of market structure to the upside. And we call this weak low or a bullish QM. Or if you don't have, sometimes it doesn't gonna see in the bearish QM you have. You can see you have a strong high, bearish QM, but you don't have a swing low like this. Your swing low is more like this. That's going to be the tree candle confirmation. You can take that tree candle confirmation just in a weak low, just for weak low, okay? Just for weak low, but the strong high should be a QM formation, should be a bearish QM formation. That's so important. That weak low formation or opposite QM is going to let us know that our bearish trading range formed. Even if you have a tree candle confirmation inside the obstacles, this is valid. That our bearish trading range has been formed, confirmed. Also, tree candle confirmation in obstacle, we're going to have same meaning for us. So I'm gonna talk about this again. So in the bearish trading range, we should have a strong high formation or a bearish QM formation, and the weak low can be the opposite or bullish QM or tree candle confirmation. That means our range form. Once we get the weak low, that means the range bearish trading form. But once you start to look for the bearish trading range, the first thing that you're gonna look for is going to be the strong high in the bearish trading range. Now, the strong low and the weak high, it's going to be the same. Okay. Now, if you take a look here, at the beginning of the bullish trading range, we are going to see a strong low, otherwise known as a bullish QM. Just follow this area here when we're going to see a stop hunt, break of market structure. Okay, so the strong low form or a bullish QM form. And at the end of the bullish trading range, we are going to see a weak high, otherwise known as a bearish QM or swing high. Okay, so for the weak high, we can see a bearish QM, we can see a tree candle confirmation. Okay, the weak low formation, the weak high formation, I should fix this, or opposite QM is going to let us know that our bullish trading range has been confirmed. Also, tree candle confirmation inside the obstacle is the same. So for the bullish trading range, what we're gonna do, it's so important to first to get a strong low formation or bullish QM. Then we're gonna get the weak high. So the weak high can be a bearish QM or tree candle confirmation. So this is going to be how the bullish trading range is gonna be worked. Now we're gonna think, okay, once we get this, what should I expect it in these type of the, in the bullish or bearish trading range that I'm gonna talk about what you're gonna expect it. So we're gonna first dive into the elements, the important elements inside this range. Then we're gonna talk about what you're gonna expect it. So now let's talk about what we expected, to be honest, in these ranges. External range liquidity, the bullish external range liquidity. Okay. So now that you understand what is a strong low or a weak high, you will now be able to understand what we call external range liquidity. So external range liquidity, okay, we call it ERL. For a bullish trading range, the QM that from the range are the external points for our trading range, so those become an external range liquidity. So these QM's formation is going to be the external range liquidity for us, but you should understand in the bullish trading range, the main external range liquidity point is a weak high. Okay, in the bullish trading range, the main external range liquidity that we are expecting to price taken out, it's a weak high. In a bullish trading range, we are expecting a new high to be created. So our target is going to be able to a weak high or external range liquidity. So in a bullish trading, as I told you, what we are expecting is price come here and create a new high. So the main position that we're going to get, it's going to be the buy here until the new high, weak high. It's going to be, we can call it external range liquidity. Okay, this is going to be the expectation that we have in the bullish trading range. So in the bullish trading range, you are expecting the weak high going to be taken out. So you're going to buy, and also you're expecting to the strong low get respected. You can expect to price take up the strong low, then go for the weak high. Okay, so it's going to be the stop hunt, to be honest. You're going to expect to price respect the strong low and take out the external range liquidity. And in the external range liquidity bearish is going to be the same. What we're going to expect is price respect the strong high, and in the bearish trading range, price take out the weak low. The external range liquidity for you is going to be the weak low. So we're going to expect the price come here and respect the strong high and take out the external range liquidity, or creating a new low by breaking the weak low. So now you understand the external range liquidity. It's so important to understand internal range liquidity. So what is the internal and external range liquidity? So external is the liquidity that it's going to be the outside, or it's going to be the main target of our. Okay, but before price take out the liquidity outside of the range, price should take out the liquidity inside the range. So these liquidity inside the range, we call it internal range liquidity. If we have external range liquidity, then surely there is something called internal range liquidity, and you've been 100% correct. Okay. The internal range liquidity are the swing highs or swing low, okay, inside of the trading range. But now you're gonna say, Ebel, but this, you mean internal range liquidity are swing high or swing low between inside the range? Yeah, the swing high or swing low is liquidity, don't forget. Buy side and the sell side. Above the swing highs, there are buy stops, and below the swing lows, there are sell stops. The low or high that get broken to confirm the trading range will also be seen as internal range liquidity. Let's take a look to what it looks like. So let's take a look in the bullish range example. So here we get our bullish range, right? Stop hunt, break of market structure, strong low formed, or weak high formed. So weak high here formed with a bearish formation of bearish QM, stop hunt and break of market structure. So you should understand our target here, our external range liquidity here is this weak high, okay, this area. But before the external range liquidity taken out, okay, there should be something taken out. The internal range liquidity should taken out. So first, internal going to be taken out. After internal range liquidity, price going to take out the external range liquidity. Then this cycle repeat. Okay, I don't want to dive into the cycle, but first, internal range liquidity going to be taken out. Now take a look here. After the strong low and the weak high formed, just see we have one swing low here, one swing low here. I forget to draw this. One swing low here, one swing low here. So these are internal range liquidity for us. These are internal range liquidity for us. These are liquidity. Now, to be honest, one of your main questions going to be, Ebel, is all of the internal range liquidity going to be taken out? No. Now, the next question is going to be, Ebel, which one is going to be taken out? We don't know which one of these internal range liquidity is going to be taken out, because we don't know how much amount or volume the market maker gonna put to drop the price and active all the retail traders orders and start to reverse it. But there is a formula that I'm going to teach you at the end of this lesson, which that you can understand which one of these internal liquidity going to be taken up 100%. Sometimes price going to take the market going to take them all of them. Sometimes the market going to take one of them. Sometimes market going to take two of them. So you can say I'm waiting to price to take all of the internal liquidity then reverse. No, there is going to be the formula that I'm going to teach you at the end of this lesson. So this is going to be the internal liquidity. Okay. Now you should understand also in this example, let me just show you in this bearish range, let me just show you the internal liquidity. So see, we have one internal liquidity here. This is the only internal liquidity that we have. So this is going to be sometimes we have one internal liquidity, sometimes we don't have internal liquidity. Then I'm going to also talk about this. Sometimes we have, 10 internal liquidity. So you should understand them all. Now you should understand there is two types of the internal liquidity that we have. Okay, we call them trading range trap, but I call them internal liquidity. It's the same thing. Now that you understand how to identify the trading range, it's now time to learn what the common traps are inside of trading range. So internal liquidity are traps. Okay, having the ability of understanding these traps and identify them will allow you to anticipate where the market is likely to draw, and it will teach you how to approach a creation situation, which is so important. First, I'll be going to explain both traps. Then I'll be going to show you some examples. So we have two types of the trading traps, type 1 and type 2. So the type 1, we can call it T1. You can call it internal liquidity. The type 2, you can call it T2. You can pretty much call it, I don't know, inducement, failure swing. It's the same name. You can just call it T1 and T2. So I'm going to call it T1 and T2. But both of them are internal liquidity because those traps are forming inside the range. Now let's dive in with the trap range type 1. It's internal liquidity. To identify trap type 1, you want to see a break of market structure followed by retracement and then a BUS again. Then retracement leg is going to be trap. So how that's going to be, it's once you have a, let's say, strong high, stop and a break of market structure. So if you get, let's take a look to this, retracement and a break of market structure, this retracement leg is going to be trap for you. Take a look to here. We have a retracement and a break of market structure. See, retracement here in the red area and a break of market structure. Okay. So this is going to be the internal liquidity. So also we have internal liquidity here. Just take a look, retracement and break of market structure. Now if you think EBOL, this is how the retracement gonna look like. If you have a swing high like this, that swing high in the bearish trading range, it's enough. You can also call it T1. So it doesn't matter. A beautiful retracement and break of market structure or just a tweak and a confirmation like this. It's the same thing in the low time frame or in the, it's the same concept. Okay. So both of these are internal liquidity type 1. So there are two variations of these trap. It can sometimes form before price takeout by external liquidity, and sometimes it will be formed after price takeout by external liquidity. But same logic applies, as I told you. Okay. So the type 1 is, now let me just simplify this for you. The type 1 is forming between the strong high and weak low, or strong low or weak high. Okay, by retracement or break of market structure, or swing high or swing low between this strong high or weak low. Okay, so this is a range trap type 1. As I told you, we don't know which one price going to take out, which one price going to be taken out, but we understand this are at internal liquidity. Again, I'm going to teach you that formula. So if you want to dive into the logic behind this, so what makes these trap? The reason why this is a trap, it's because the large majority of the traders are going to try to buy or sell from this price leg. So there are stop losses as well as protective buy stop or sell stop resting above or below it. This is because why are trading based on the market structures? This is because they are trading based on market structures alone. So the reason is so simple. Just take a look to this example. We have the strong low and we have the weak high formation here. So strong low and the weak high formed. So just take a look. We have retracement and break of market structure. So this is going to be internal range liquidity for us. So the retail traders, it's a sell stop. The retail traders gonna put their pretty much buy sell stop here. I'm sorry. What they gonna do? The retail traders, some of them gonna buy here. How they gonna buy? They're gonna say the equal high. They're gonna buy here. Some of them they're gonna start to sell here and put their stop loss here. So a lot of them you're gonna see, as I told you, buy some from this price leg. So you're gonna see the retail traders try to fight here, to be honest. But again, if you have an equal high, so you can understand this. If you, for example, have an equal high, you can understand a fake reaction and price at least take out this liquidities here. If you have a sell stop here, you can understand price gonna activate this and start to reverse, which that is going to be happen. In a bullish scenario, so they see a higher high or higher low and another higher high, so they expect that recent higher low to hold. In a bearish scenario, they see all lower low, lower high, and another lower low, so they expect that recent low to hold. After it fell, their stop losses will going to be hit, and buy or sell stop have been triggered, and price will reverse again and leaving them in losses. So again, what I told you, first price gonna take out the external range liquidity. Then what price gonna do? Respect the strong low. Then price take out the external range liquidity here. So even if the stop loss here hit, even if they are in the sell side, sell a stop order, their stop loss gonna be hit here too. So you should understand this logic behind this to pretty much to easily aikido the market. Now we're gonna dive into range trap type 2. Now let's dive into range trap type 2. So to identify trap type 2, we have to understand what known as a failure swing. So what is the failure swing? A failure swing is when a price fails to create a new structure. Let's say if I want to draw it for you, structure high or low, and then it broke the structure in the opposite direction. So that means, let's say one price failed to create a new structure here, failed to break this high. Okay, when this low failed to take this high, price this area is going to be failure swing. Okay, nothing is 100% in the market, but this is the signal, and we can we can then anticipate that the market is forming a failure swing. Okay, this can happen pretty much either there is an internal liquidity in the trading range or not. So let's say we have a strong high here and we have a strong low here. So yeah, I mean the strong high formed, the weak low formation formed here. You have the internal liquidity, you have a retracement break of market structure, you have a swing high here, you have a swing high, you have swing high, you have a swing high. Okay, you have a bunch of internal liquidity here. So now, as I told you, we don't know which one going to be taken out, but just take a look at this example here. This high failed to take this low here, right? So you can see this high failed to take this low here and tap to the obstacle and showed that this high failed to take this low, because we know after internal taking out, price going to go for external. But here we can see this high failed to do that, right? So this is going to be your T2, impermanent liquidity or inducement or failure swing, T2. So what's going to be like this? It's going to be the liquidity. So price going to take this and start the bearish movement again, right? Now I'm going to talk about the logic behind this. Now, but you should understand we can have a T1 and a T2 in the same time. This is so important, T1 and T2 at the same time. So you have a T1 here and a T2 in the same time. And as I told you, if we have a bunch of internal liquidity here, we don't know which one of these is going to be taken out. So it's better to follow the formula that I'm going to teach you. The formula, to be honest, is so easy. Let me just tell you right now. So once you have a strong high, once you have the range, okay, you're going to identify your weak low if you're in the bearish range, or a weak high if you're in the bullish range. So let's say that this is the bearish range, this is the weak high. So this is going to be your weak low, right? Now you're going to say, we're going to, first of all, draw all of the internal liquidity that you have, okay? Then you're going to give them a number. So 1, 2, 3, 4, 5, okay? So then you're going to ask yourself, you're going to first take a look at the first internal liquidity, and you're going to ask yourself, is the first internal liquidity make a connection with the second one? So what I mean from a connection, I mean equal high or equal low. So you can see we have an equal high here. Nice. So now this is a good internal liquidity point here. Now you're going to same this. You're going to ask yourself, is the first and the second one make connection with the third one? So if you take a look, this is the third one. Okay, these two, no, these are not. This is not equal high. So this area is the safest internal liquidity that you can have. And as you can see, if you draw a line here, let's say, I don't know if price take this high or not. If not, you can see price come back and take this high again. This is one of the powerful internal liquidity formula that you can use. So this is how you can understand which internal liquidity, once you have the multiple internal liquidity, which one of these have a high percentage of price taken out that. Okay, so we can have a trap 1 and 2 in the same time. Okay, now let's dive into the pretty much the logic behind this. The logic is, what's make this area trap? There are buy and sell stop orders above, below. There's pretty much annotate trap. The market, when triggers those pending orders and reverse leaving their traders losses, once that high or low has been taken out, many traders believe the trend is changing since price created a new higher high or higher low. When else is the stop hunt, so they will attempt to trade in the wrong direction, and so they gotta stop out. So in the simple language, let's say this is internal liquidity, right? So what they're gonna do, they're gonna see, because of this bullish reaction, they are looking for buy here, they are looking for buy here, they are looking in the wrong direction. But how are you gonna understand? Don't think about the retail traders where they're gonna buy, they're gonna sell. Think about what you're gonna do. So what are you gonna do if you see this low here? Let's say, okay, this is a T2, right? Because between the strong low and a weak high formation, we don't have any internal liquidity, so this is going to be the T2 for us. Okay, this low start to go up, fail to take the external liquidity, so this is going to be T2. So you know this area is a T2, and you see price come down and give a reaction. So what is this reaction? Is this reaction from there for you? Yes, this is an equal low, right? So the retail traders right now, they're gonna say, oh, break of market structure, let's buy. And also some of them gonna say, oh, we have an equal low here, let's buy. But no, what's gonna be happen? Price gonna tap here, give us the fair reaction, and they're gonna took all of the stop hunt, took all of the liquidity over there. So you should be smart. You don't need to just summarize. The reason that I don't put diagram in this PDF for you or ebook is I don't want to just summarize them with the diagram. You should see the example and work with the example, right? It's like that you are MMA fighter and your coach put you in the ring from the first session. So once you get professional, you're gonna be the best MMA fighter in the world, let's say. It's going to be like this. So that reason, I want to just take a look at this again. This low, start to go up, fail to take these highs, okay? At least create one break of market structure. So we can understand this low going to be liquidity, okay? Now you're going to say, Evil, when are we going to understand this low going to be liquidity? Yeah, once prices fail to take this high. Now you're going to understand when are we going to understand this low fail to take that high? Once price create a trick in the confirmation in the obstacle. See, once we have the obstacle, once we have a trick in the confirmation, that's mean that's low fail to take that high. So, and what you can see here, equal or trend on liquidity. The retail trader is gonna say, I'm gonna buy here. Let's go to buy here. But all of them gonna be taken out, and you're gonna see price gonna take out the T2 and start and take out the external liquidity. So here, just take a look to this low. This low start and create at least one break of market structure to the outside. That means this low was successful at that, taking these highs and create a break of market structure. So that's mean price, this low is not going to be a T2 for us, right? So the strong low going to be respected, and external liquidity going to be taken out, or weak high going to be taken out. So now we're going to understand, we're going to talk about the premium and discount. So don't worry, I'm going to send you 100 example of the ranges for you. That's going to be help you to understand this, and you're going to access to this PDF. At the end of the video, I'm going to talk about everything, how you can access this for free. No worries. Now let's talk about the premium and discount level. The premium and discount level is so important. Once we have our trading range identified, we can now implement what we call the premium and a discount. In a simple term, the discount it's mean cheap, and the premium it's mean expensive. The logic is so easy. Let me just say, I just bought this iPhone. I want to buy this iPhone, let's say. When I go to the marketplace, I want to buy this iPhone in the cheapest and the best quality in the marketplace that I can find it, right? So I want to find the best quality in the cheapest price in the marketplace. This is going to be the discount area of the market. Now, let's say I want to sell this iPhone, so I want to sell it in the highest price available in that marketplace. So if I want to sell this as a second hand and it just have a 90% of the battery health, I want to sell this in the highest price available in the marketplace because I want to make some money, right? I want to at least make some profit, right? So this is going to be the premium. So once you have a bearish trading range, okay, what is the purpose of the trade, of that range? To sell, right? In the bearish trading, we're going to sell, and in the bullish trading, we're going to buy. So once you have the bearish trading range, you want to sell at the highest price available in the marketplace, okay? So that is in the premium area. You're going to just look for a position at the premium area. You're going to look for POI, position at the premium area. So now that's it. In the bullish trading, it's going to be the same. Once you want to buy in a bullish trading range, you want to buy at the lowest price available. So you're going to just look for position in a discount area. Even if you have the bearish trading range, that price didn't come to the premium area, don't sell it in the discount area. Okay, this is one of the rule. Make this rule for you. Don't sell in the discount and don't buy it in the premium. And this here is the Fibonacci that you can use. This is the setting that you can use, and that's it. This is the rule, one of the rules that's so important. Now, after video, once you get the PDF, once you practice this, now you want to understand where you want to buy, which area you're gonna buy, which area of these areas you buy. You're gonna go to my YouTube channel and you're gonna look for the POI video that I had. If you watch the POI video and practice it with this, you have my strategy. To be honest, you have my strategy. That's it. So let's go to the trade now. Once you understand this, we're gonna go to the trading range cycle. One of the important thing here, and one of the important thing, to be honest, that you should understand the trading range cycle. We have converted the basic core elements of the trading range, the QMs, which represent either strong high or a weak low, or a strong low or a weak high, the external range liquidity, which are the external points of the range, especially the weak high or weak low, since those are the target to create a new high or new low. Internal range liquidity, which are the highs or lows inside of the range, and lastly the premium and discount, to know which area of the range we are going to look for buy or sell from. I have taught you all of them pieces by pieces, and now it's time to blend them all together, okay, and take advantage of what we call trading range cycle. The trading range cycle is simply the process of price seeking the internal range liquidity to then target the external range liquidity, and then from external range liquidity back to seeking the internal range liquidity, and so on. So in the simple language, the trading range cycle is first price going to take up the internal liquidity, then price going to go to the external liquidity, and from external liquidity again going to start to seek and go to the internal liquidity and take out the external. So this is the range cycle, which is so important. If you be a smart trader, you're gonna see this range cycle is so familiar to the buy side and the sell side. So you're gonna say, okay, so internal liquidity can be buy side. And the external liquidity for sure is going to be the opposite type of the liquidity from. It's going to be the sell side. So if once the buy side take out, price going to go to the sell side. And once the sell side going to take out, price going to do the buy side. Now here you're going to understand some deep secrets about the liquidity, which you should understand it by yourself. I can't say right now. So, but in the simple language, once we have the strong high, stop on a break of market structure here, okay, and we have the weak low formation, let's say, once you have the internal liquidity. So just take a look at this. We have one internal liquidity, 2, 3. So we have 3 type of the internal liquidity here. And as I told you, you're going to use that formula that I told you. I'm sorry, I'm just sticking my nose. I have a little bit allergy to the session that I have right now, to the decision I'm sorry. So that reason. So yeah, before we dive in, just take a look at the formula. First, second, and the third. So the first one is make a connection with the second one, and the first and the second one make a connection with the third one, right? So these are going to be the safest internal liquidity that we can have. So, and also if you take a look, this high failed to take this low, right? So these are going to be the T2 here. So we can have a T1 and a T2 at the same time. So we can see price first take out the internal liquidity, then price go for external liquidity. And as we can see, price tap to the point of interest that you can, as I told you, you can go to my YouTube channel and watch the best order block or worst point of interest video that I have. It's a mini course like this. Then once you practice this and once you combine this, you're going to have one of the powerful strategy in the world, to be honest. And I hope this is going to be make sense for you. So now in the next part, I'm going to teach you how you can download this PDF and how you can get the 100 example of the range for free. Let's dive in. So simply how you're going to purchase this is so easy. Once you're going to go to the description and tap to the link that I put. You're going to come to this area and there is some guide here that I'll just write for you that you can read it. Okay. You're going to hear name for a fair price. You can put anything that you want. Anything that you put here is going to be go for the donation. Okay. So, or you can put it as 0 and you can tap to the purchase here. I already purchased it. So you're going to put the email address that you're going to use it. It's so important. The valid email address that I can send you the PDF over there. Then you can add a tip. You can put a 0. You can put a $10. You can put a $5. All things that you donate here, I'll give you a tip that's going to be go for the donation. Then I'm going to tap to the get. Once you tap to the get, check your email. You're going to get an email within a minute. And that's it. Hope you liked the video. Don't forget to like and subscribe. See you guys in the next video.